Hello and welcome to Wake Up America. There are many areas where the United States economy lags behind the rest of the world. We produce less clean energy as a proportion of our consumption. We rely more on imports. We fail to provide adequate safety nets to our citizens. And our government relies exclusively on foreign loan financing to cover its unfunded spending. No other developed economies have such stark oversights or lapses in their structure. But there is one oversight that is perhaps the most glaring. Nearly every nation in the world employs a border adjustment tax, commonly the value-added tax, as a means of growing revenue while also fostering domestic growth. The United States is the only developed nation that does not have some sort of border adjustment. The VAT is a sort of national sales tax, which appends a tax to goods and products at each point of sale. It taxes the value added to goods and services within the economy as a whole. This has two main effects. First, it makes all goods relatively more expensive, and the tax itself is somewhat regressive. Poorer individuals end up feeling a bit more brunt than the wealthy, and overall consumers are able to purchase fewer goods. This may seem like a bad thing, but the benefits outweigh the costs due to the second effect. The VAT taxes the entire economy at the point of sale, including goods coming into the economy from producers overseas. In so doing, it doesn't just make domestic goods more expensive, it also makes foreign goods more expensive. For example, an exporter in the United States who is looking to sell goods in Germany must first pay the cost of making the good and shipping the product overseas, and then add an additional 15% cost to that product at the border. This makes the U.S. good 15% more expensive than its German counterpart, and German consumers have a reason to buy domestically. By not having a VAT for itself, the U.S. misses out on this aspect of the border adjustment. American goods entering Germany, Japan, China, France, Canada, and Mexico, or any number of the other 140 nations that use the VAT, are all marked up. This makes them less cost competitive against domestic goods. Meanwhile, products coming into the U.S. from all of the aforementioned nations have no such burden. Implementing a VAT in the U.S. would be difficult and time-consuming, but in the end, the benefits are simply too great to ignore. The VAT may make goods more expensive, but it simultaneously encourages domestic production, and likewise domestic job creation. It shifts tax burden away from income and corporate taxes and asks that other nations pay for access to a given market. There is a reason it is the most widespread and successful tax system in the world, and the time has long come that the U.S. at least consider instituting an internationally competitive VAT of its own. For more related news and topics, please tune in and log on every day at economyincrisis.org.
Wake up, America! Open up your eyes! Wake up, America! Wake up!